Your credit score is not just a number. It is a number that decides how much everything costs you. Your rent, your car payment, your mortgage, your insurance premiums, the interest rate on every loan you'll ever take. All of it, directly affected by three digits that most people don't fully understand and nobody ever properly explained. Let me show you what I mean in real dollars. Take two people buying the same $350,000 home with a 30-year mortgage. Same home, same down payment. The only difference is their credit score. The person with a 760 score gets an interest rate of around 6.5%. Their monthly payment is roughly $1,396. Over 30 years, they pay about $332,000 in total interest. The person with a 580 score, if they get approved at all, pays around 8.5%. Their monthly payment is roughly $2,168. Over 30 years, they pay about $466,000 in total interest. Same house, $134,000 more, paid entirely because of a credit score difference that nobody explained how to fix. By the end of this video, you will understand exactly how your credit score is calculated, what moves it up and down, the fastest legitimate ways to improve it, and the mistakes most people make that silently destroy their score without realizing it. A credit score is a three-digit number between 300 and 850 that represents how reliably you've repaid borrowed money in the past. Lenders use it to predict how likely you are to repay borrowed money in the future. The most widely used scoring model is called the FICO score, created by a company called Fair Isaac Corporation. When most people or lenders talk about credit scores, they mean FICO. There are other models, but FICO is the one that matters most for the decisions that affect your life: mortgages, car loans, credit cards. Here's how the score ranges break down and what each range means in practical terms. 800 to 850 is exceptional, best rates available, and automatic approvals. 740 to 799 is very good, very competitive rates, and you're rarely denied. 670 to 739 is good, standard rates for most things. 580 to 6069 is fair, higher rates and deposits required. 300 to 579 is poor, frequent denials and only secured cards available. The sweet spot most financial goals require is 670 or above. That's where you move from fair to good, and the rates and approvals change significantly. Getting above 740 is where you access the genuinely competitive rates that make a meaningful difference over a lifetime. Your FICO score is made up of 5 factors. Each one carries a specific weight. Understanding these 5 factors is the entire key to improving your score, because you can't move a number you don't understand. Factor 1, payment history at 35%. Have you paid your bills on time? This is by far the most important factor. One missed payment can drop your score by 50 to 100 points. Consistent on-time payments build it steadily. Factor 2, credit utilization at 30%. How much of your available credit are you using? Lower is better. The general rule, keep utilization below 30%. Below 10% is ideal. This is the fastest factor to improve. Factor 3, length of credit history at 15%. How long have your accounts been open? Older accounts help. This is why you should rarely close old credit cards, even ones you don't use. Factor 4, credit mix at 10%. Variety signals experience. Factor 5, new credit at 10%. Each application creates a hard inquiry that temporarily lowers your score. Multiple applications in a short period raises red flags. Payment history and credit utilization together make up 65% of your score, which means the 2 most powerful things you can do are pay every bill on time without exception and keep your credit card balances low relative to your limits. Everything else matters, but is secondary. If you nail those 2, you will have a good credit score. If you nail those 2 consistently for years, you will have an exceptional one. My credit score at its lowest was 561. I had missed payments during my worst debt period. I had credit cards at 90% utilization. I had applied for 3 new cards in the same year, which tanked my score. I had done almost everything wrong without knowing it. When I finally checked my score, really checked it, I was genuinely shocked by how low it had fallen, and then I started learning how it actually worked, and then I started fixing it. Within 18 months, my score was 714. Within 3 years, it was 768. Not by doing anything clever or complicated, by paying every single bill on time, paying down my balances, and not applying for any new credit for 2 years. That's it. That's the whole strategy. It works. And the rates I accessed with a 768 compared to what I would have paid with a 561, the difference over my financial life is genuinely staggering. Here are the fastest legitimate ways to improve your credit score, ranked by speed of impact. Fastest impact: reduce your credit utilization. If you have credit card balances, paying them down dramatically is the single fastest way to move your score. Utilization changes are reported monthly. A big paydown can show up in your score within 30 days. Get below 30%, or ideally below 10%. Fast impact: become an authorized user. If someone you trust has an old credit card with a long history and perfect record, ask them to add you. Their positive history gets added to your file. You don't need to use the card or even have access to it. You just benefit from their history. Medium impact: set up autopay for every account. Payment history is 35% of your score, and a single missed payment is genuinely damaging. Remove human error from the equation entirely. Set every account to pay at least the minimum automatically. Medium impact: dispute errors on your credit report. 1 in 5 people have errors that are negatively affecting their score. Pull your free report at annualcreditreport.com, the only federally authorized site. Check it line by line. Dispute anything inaccurate. Successful removals can significantly improve your score. Slower impact: keep old accounts open to protect your history length. Closing an old card, shortening your average age, can hurt your score. And if you're starting from scratch, apply for a secured credit card. A cash deposit becomes your limit, and on-time payments build your history. Responsibility returns your deposit in 12 months. Now, the mistakes. Closing old cards shortens your history and raises your utilization ratio even if balances haven't changed. Keep them open. And applying for multiple cards or loans, each hard inquiry drops your score. 5 inquiries in 2 months signals financial distress. Space out applications by at least 6 months. Carrying a high balance even if you pay it in full. This surprises people. Your utilization is calculated based on your statement balance at the end of your billing cycle, not your balance after you pay. If you charge $4,000 on a $5,000 limit, your reported utilization was still 80%. Pay down the balance before the statement closes. Ignoring collections is severely damaging and stays for 7 years. Address them. Even settling for less is better than leaving them unresolved. And co-signing: when you co-sign, you are fully responsible for that debt. Their missed payments become your missed payments. Co-sign only for people you would trust with your own score. Your credit score is not a verdict on your worth as a person. It is a mechanical system with 5 levers. And now you know exactly what those levers are and how to pull them. Here's your action step for this week. Go to annualcreditreport.com and pull your free credit report from Equifax, Experian, and TransUnion. Pull all 3. Check them for errors. Look at your payment history. Check your utilization on each card. Then pick one thing from today's video and do it. Just one. Reduce one balance. Set up autopay on one account. Check for one error. One action this week. Drop your current credit score range in the comments. You don't have to share the exact number, just the range. And tell me which action from today you're going to take first. I want to see where everyone is starting from. Next video is one I'm genuinely excited about: salary negotiation, how to ask for more money, what to say, and the $40,000 I left on the table in my 20s by not doing it. That video is up next, so make sure you're subscribed. I'm Clara, this is Clara Cents. Go pull your credit report.